In this video, we're going to be resolving your trading issues, all of those issues with fear, uncertainty, doubt, FUD, you might even say it, FOMO, overconfidence, underconfidence, inaction, or too much action. These sort of things are what we're going to be addressing on this video. And this is really stemming from my own background and now doing this for a very long time with many other people as well and seeing what other people go through too. And I've really come to, over the years, the resolution to just about all of the trading psychology issues, which first, before we get into this whole presentation, I should preface this by saying this is going to assume that you're coming from like a relatively well-adjusted background. You don't have any like real psychological issues. If you do, this is outside of the scope of this presentation. You should seek real medical help is what I would think. And please do not be offended by the definitions here. I'm just going off of scientific definitions, and that is the most appropriate for this conversation. So now that we have that out of the way, what are psychology issues? Well, psychology issues, in my experience, are really just strategy issues in disguise. A strategy should be, or at least the purpose of a strategy, is to provide the decision-making framework that you can, of course, trade or invest from, which essentially means that all of the planning has been done in advance. Meaning that all of the emotional things that we deal with or that you might be dealing with before entering into a trade, these can be resolved by simply just planning in advance. And those issues typically come from, a lack of a coherent strategy. That's really where it does come from. And I think after you go through this whole presentation here, you'll very likely agree with me on that or come to your own conclusion, which will probably be relatively similar. So moving on from there, here are the common psychology issues that we typically run into. First is uncertainty. That is simply just, what do you do? What do you do? Should I enter here? Should I exit here? Should I manage my risk here? Again, you can even tell just by the, just by the words that we use, this is a strategy issue. But basically, uncertainty, of course, creates that, that sort of emotional state where you don't know what to do. And because you don't know what to do, you get flooded with these sort of bad emotions. You feel uneasy. You get that feeling in your chest like, oh shit, I need to make a decision here, but I don't know what to do. Again, the decision-making framework is what we're interested in. That's how we resolve uncertainty. The next one would be overconfidence or underconfidence. This typically comes from when you have a string of wins or a string of losses. When you have a string of wins, you get super confident. You're like, damn, man, I'm just fucking on fire today, baby. I'm going to be even more aggressive now. And inevitably, over time, that can lead to a couple things. Obviously, when you get more aggressive, you're probably not playing towards a strategy. And inevitably, the opposite starts to happen. And underconfidence, you don't take enough risks, and you might be feeling underconfident, or I suppose just not confident at all, because you took a string of losses, and during that string of losses, you feel like I don't even know what the hell. How did I ever know how to do this? How do I even press the buttons at this point? This issue can obviously, ruin your trading behavior, because at the end of the day, you do need to take risks in order to trade. I mean, that is what trading and investing are. It is risk taking. Fear of loss, of course, we all know this one. You get into a trade and immediately you're like, oh my God, it's going against me by 1% or 10% or whatever. I'm going to lose everything. I'm going to lose my life. I'm going to lose my house. I'm going to lose my kids, my job, whatever, this loan that I took out to trade with, whatever it might be. And that, obviously causes many issues pertaining to, actually following a trade plan. And FOMO, we all know this one, fear of missing out, and inaction. So we're going to go into more detail on all of these one by one. We'll work through them, starting off with uncertainty. So I did want to say that psychology issues are really decision-making issues. Is what they are. And we should actually define the term decision here, because I think that will really enlighten you, if you're not already aware of it, like the actual definition of where it comes from, because I think that it's incredibly liberating to actually understand the purpose of a decision, which decision making. So The word decision actually comes from a Latin word, which actually most English words do come from, if you actually look this up, which is decidere, which translates to cut or like kill off. So D or de equals off, cadere equals cut. So you're literally, when you're deciding something, you're cutting off all of the other futures that you could have had by following that path in order to follow this path. So just in the word in and of itself with decision, when we make a decision, we should actually forget all the other instances that we could have potentially had. So when you decide to enter based off of, a strategy of whatever, you shouldn't be thinking about, well, what if I did this? Because that is not the strategy to begin with. When we make the decision, we forgo all of those other opportunities. Therefore, it is illogical to be entertaining those as, realistic endeavors. Like, we've cut them off. They're dead to us. And so as we go through the list right here, yes. In other words, the purpose of a decision, or of making a decision, I should say, is literally to kill off all the other options. In this way, we intentionally forgo other opportunities in favor of the decision we make. Just reading straight off of the presentation here. So moving from there, let's get into uncertainty. Uncertainty is due to a lack of pre-planning and can lead to overacting or underacting. This is resolved by explicitly stating your strategy before ever entering an entry into position. So again, very, very simple here with uncertainty. You feel uncertain because you don't have a plan. You don't have a plan because you didn't plan in advance and actually backtest that and understand thoroughly what that strategy is likely to return, what to expect from that strategy, which can only get from backtesting and then deriving strategy statistics from. With that, you will resolve uncertainty. It is quite literally that simple. You're uncertain because you should be uncertain because you actually don't have a plan. That's a beautiful thing about our emotions. Assuming that you are, again, relatively normal person, and I use, again, normal just in the scientific sense, like just the average person, your emotions are set up to actually support you in your endeavors. You feel uncertain because you're supposed to be uncertain if you don't have a fucking plan. It's that simple. It's that fucking simple. If you feel uncertain and you do have a plan, well, then you have an actual psychological problem, most likely, in which case the real answer to that is to progressively desensitize yourself. So what do I mean by that? I mean to progressively or continually expose yourself to that stimulus, and then over time, you'll be able to go more and more and more. You push your comfort zone a little bit more over time. It works like that. And you just have to trust at the beginning that if you do the right actions, if you take the right actions in accordance with your plan, because that was the real part, then your emotional state, it will follow. It'll follow and fall in line over time, and you will become, I wouldn't say certain is the better word, but you'll become more, I suppose, confident in a way that over time, things will work out, and you can feel uncertain in the moment or on this particular iteration. That's fine. We're interested in the long-term results. That's what we want. Anyways, the proper way to set up a strategy, of course, as we'll go through many times in this video, is have objective definitions for entry, exit, and risk management as bare minimum. If you have objective definitions for entry, exit, and risk management, how can you be uncertain of what to do? If you literally have a condition, and I'm not saying that this is going to be a good condition that will actually work, but just as an example, let's say that you want to see the 21 exponential above the 55 exponential. And when that happens, when that cross happens, I'm going to enter in long. Okay, well, that is an objective definition. Now, is that going to work in a strategy? Again, no, probably not very well, at least on its own. But as far as objective definition for entry, that is an example of what that would look like. You can add obviously many other conditions on top of that, of course, as well. But would you feel uncertain if you had that as a framework to enter? I mean, quite literally ask yourself that question. If the answer is yes, you'd still feel uncertain, then, well, progressive desensitization is the answer. If you are still uncertain of what to do, despite designing a strategy for entry, exit, and risk management, that's a clear sign as well that your strategy might not be objective enough, like your definitions. And this typically happens with like drawing lines and whatnot. Again, I've seen this work. It can work for sure. But the problem is that without an objective definition, without an objective indication, we're not standardizing for what an actual signal should look like. So, if you're drawing trend lines, for example, let me just bring out some examples right here. If we were drawing trend lines, like, okay, how do you know where the right trend lines are the right trend lines? I mean, is there going to be like a very objective way to define that? Probably not. It's like, do we have one here? Do we have one here? Do we have one, here? These sort of things are going to be question marks. That's why, in general, I default towards indicators, because they spit out very, hard numbers, which is what I'm more interested in. Again, doesn't mean that it can't work. Just if you're still in the in the sort of newbie phase, I think it's better to kind of avoid that at the beginning. All right, overconfidence and underconfidence. So again, this typically comes from a streak of wins or a streak of losses, and the sort of emotional state that we enter into after a string of wins or a string of losses is one of overconfidence or underconfidence, which means that we become a little bit too aggressive if we're overconfident, meaning that we don't think that we can lose ever again, or we just start to size up a lot on our trades, or take trades that maybe we shouldn't have, because we have entered into that emotional state where we think that we can't lose. Underconfidence, quite literally, just the opposite of that. We lose so many trades in the road that we start to fantasize about the worst case scenarios and how we can never ever win again. And with that, well, why even try? And both of these are kind of issues from the same thing. The resolution really is to spend time meditating on these strategy statistics that you have developed or derived from actually backtesting the strategy, and recognize that a strategy is meant to be played out over many iterations, over many years, really. And so think about it this way. If you had 10 wins in a row, but that your strategy hit rate over the past, let's say 5 years, 10 years, 100 years, whatever, is 50%, should you become overconfident? No, like, you expect that to go back into sort of normality over time, or closer to normality over time. So we should neither be emotionally motivated when we get or overconfident when we have a lot of wins in a row. And likewise, we should actually not be emotionally affected when we are having many losses in a row as well. It's the same thing. It's just a lack of understanding of what the strategy is not supposed to, but is likely to return over time. Again, that is the purpose of backtesting. When we backtest, we figure out what the win rate is over time, average percentage win, average percentage loss, all sorts of other things as well. But these sort of things can give you a baseline. And from that baseline, you can then ask yourself, does this make sense? Is this logical to be feeling emotionally affected by? And if the answer is no, then the answer is fucking no. If it is yes, then, well, again, probably a sign of the actual strategy breaking down, which can also happen as well. But again, we want to assume continuation of that history first before anything else, because that is what's most likely. All right. And that is why it's better to generate longer data sets, because it gives us more confidence over time. All right, fear of loss. Of course, we've all felt this one. When in a trade that might be going against us, we might begin to have fears as to what the loss will be, or this fear drives us to kind of do something off plan, like cutting the trade early or not taking the trade at all. These sort of things are stemming from that fear of loss. And so in our strategy testing, we should have derived the average loss per trade, which is a direct metric that you can reference to know what we should actually expect to lose. And we should also actually know the maximum loss that we have in our data set as well. And even the maximum consecutive losses in a row. Like, what is the worst case scenario? Throughout history, how many consecutive trades has it lost in a row? And what was the total loss in percentage terms of the account from that period? And we should really meditate on that and ask ourselves, do we accept that loss? Because if we don't, we're oversized, or the strategy is just not fit to our preferences. Both of these can be at play here. But of course, without that information, without deriving that information from the planning phase, we're not going to have that. We have nothing to go off of, and we should fear loss because we probably will lose more over time than we should have. So that is, again, a normal fear to be having, assuming if you have not done the actual work in backtesting. So from there, we can go to FOMO. We all know FOMO as well. The fear of missing out comes from basically a scarcity mindset, to reference the abundance crew. But, you get into this mindset where you feel like this opportunity will never present itself ever again. And this, again, comes from a lack of trust that you can actually even repeat these actions again, which is certainly possible. And then two, it would be similar to saying that this opportunity will never present itself ever again. So I need to jump on this now because otherwise it's gone and I'll never have this potential to make whatever your fantasy money is about as well. And that is just a fundamental misunderstanding that markets have been here since the dawn of time, and they're going to be here long after we're gone as well, or the dawn of mankind, I should say, at least. They're not going anywhere. And while you might not make this exact opportunity, there will be more in the future that present itself. Again, assuming that you have some sort of a plan that told you that there was an objective edge in the situation that you can capture and capitalize on. If that's not the case, then you're just FOMOing, and you should expect zero over time, because that is the expected value when you don't have a strategy. When you don't have a strategy, your expected value over time, over enough time, is quite literally zero. It has to be. It literally has to be. Literally has to be. There is no other way. Like over a long enough period of time, if you draw that out, it will be zero, 100%. And that's actually one of the few things you can say 100% with. Anyways. Capitalizing future opportunities, again, is a function of strategy creation and execution. If you have a strategy and it tells you what to do, and you fear missing out on this particular iteration of that, of those objective signals, there's always gonna be the next one. And we should actually have a pretty good idea, granted our strategy, of how often those signals do come around and what to expect there as well. And again, when you go over the history of whatever asset that you intend to trade or invest in, you will notice that there are many, many opportunities of similar, of similar stature and probably even more throughout the history of time. And there will be again in the future as well. I can assure you of that. Okay. You probably heard this repeated in a bunch of different angles at this point, but plan and test your damn strategy. That is the answer to pretty much all these psychological issues. These psychological issues are strategy issues in disguise. And if we simply just took the time before ever even considering entering into a trade to actually plan these things out, we're going to significantly reduce or at least or maybe even eradicate all these issues. Again, assuming that you come from a normal background. So I'll give you a little bit of strategy planning 101, and then we'll actually go into just an example over here as well. And I'd like to apply this in sort of the framework that we've been looking at. So I want to say at the beginning, this particular strategy right here is probably not going to be good. Okay, just as an example. But here would be an example of an entry, exit, and risk management, which are a bare minimum for defining a strategy with objective signals. So for the entry, we could have, we are looking for an objective signal that identifies a higher probability of some sort of subsequent price action that we're looking for. Could it go up? Could it go down? By how much percent? Whatever. That's what we're looking for there. So for this example, I'm saying I'm going to be looking for the 21 to go above the 55 exponential moving average, and then I want to see the RSI below 40. If those conditions are true simultaneously, we enter. And that is literally a question of yes or no. Do you have uncertainty when you have that laid out? Well, hopefully not. And if you do, trading is not going to be for you. I'm just, but again, in a more serious tone, I am making a little bit of a joke there. You can progressively desensitize yourself to actually be comfortable with that over time. Again, just continually just take the action with a smaller amount, and over time build it up, and it will come to you over time. For exit, again, this is profit taking, I should say here, an objective signal that identifies that your open trade is unlikely to continue, or at least to a high probabilistic degree in that current direction. Therefore, you should take the profit now because it's more uncertain that that you will continue on later, and thus you have actually a greater probability of maybe giving some of those profits up. It's better to lock it in now. So just for this example, like my RSI just traded above 70 on a closing basis. I'm just going to take my profit. Again, I don't think this proposed strategy here will work, but just as an example. And then risk management, objective signals that identify that the trade that is open has gone too far and negatively against you, and it would be best to take the loss now rather than wait later, because it will likely get worse later. And of course, if we take the loss now, we open ourselves up for the opportunity of taking another trade in the interim rather than holding on to this current trade, which is going to, one, cost us time, and two, cost us probably more money if we keep it open. So for this, this is just a common one that I use on a lot of things, just as like kind of an idiot-proof way of doing it, which does actually a pretty decent job. Not perfect, not optimal, but it is decent. And that is just a close below the Lux Algo range low. So if you're using some sort of a support and resistance thing like you see over here, let me just bring it up. You could say, hey, if my trade is open, then I'm going to be looking at that a long trade is open, I should say. Then I'm going to look at the last blue line. And if price closes below that blue line, I'm out. Probably going to get worse. And as you can see, a lot of these do come with actual continuation. So funnily enough, it does work decently well enough. Anyways, okay. So we've gone through a lot of things here. I hope I've not been too offensive in this whole presentation, but it seems to me like the pendulum of society is starting to swing now. So it went from like, don't hurt anyone's feelings now to like, fuck you. Maybe not that far, but I do think it is swinging back in the other direction, which is probably good. So yeah, let's go over an example here. What I like to use for an actual trade strategy or checklist, whatever you want to call it, is just this basic format here. Just really simple shit. Really, really simple shit. I always get questions of, hey, can you send me the trade strategy checklist? Like, sir, go on fucking Google Documents and just type in these 7 things, and I can assure you, you can make the exact same one, and it is very, very simple to do. You could also just screenshot this. You can also just do whatever. You could also write it down on a piece of paper. It's all good. I always get these questions, and it always makes me say, oh man, oh man. But it's a general audience, so it is what it is. I do understand that the majority of people completely get this. So yeah, we want to know, we want to define all of these things in advance. As many things in advance that we can define is better. So at minimum, we want to know what time frame will we be trading, what side of the market, long or short, what will be used as far as indicators go, and then their settings for that. So in this case, I'm using these guys right here. And then from there, we can talk about risk management. Again, I say close below range low. Use the Lux Algo. It's just a super easy way to do it. And it's not going to be perfect, but it gets the job done most of the time. How positions be entered, some sort of criteria for that. In this case, I want to see the 21 versus 55 EMA upside cross plus BBWP above 50 percentile. And then in this case, how will positions be exited, whatever happens first, or you can add all simultaneous conditions. Again, it's up to you. And whatever your testing does, or whatever your testing suggests. But in this case, I just look for the Joule fib to be above 95, just an indicator and value, indicator plus value on closing basis. And considerations, I might have like a stop loss by percentage. Obviously, I'd put in like the actual percentage here, but just as an example, you might want to like omit certain days. These sort of things could be other considerations that you might have that could increase the hit rate that you should, test after you get done with the base format here. So in this case, I can just show you in this pane here, this strategy. It's a very simple strategy. It's actually not the exact one that I laid out right here. In fact, if I want to bring out the exact one here, I think it was this one maybe. But either which way, it doesn't matter. What matters is the example here that I want to be giving. This is a very simple strategy as well. It's basically, it's literally just a moving average strategy plus BBWP, so volatility. And over time, we can see that it does have a nice positive equity curve. But more importantly, this addresses all of our questions. Now, recently I've been doing this this crypto school, right? This crypto school, which actually I'll bring up on the other thing here, because you can actually join it. It's free. It's easy enough to do. I think the next, or not, I don't think, but the next live class is going to be in 4 days. But this kind of comes up a lot there, where people want to see examples of stuff. And I totally get it. You know, you want to see examples when you start doing something new, 100%. It makes a lot of sense. But it is funny once you have kind of seen the other side of things, and then you hear a question like that, because all of these questions are answered by literally just understanding the strategy. In this case, let me just double check. I want to make sure. Okay, yes, we want to see BBWP above 50. And then is anything else? Yes, we want to see the BBWP positive. And yeah, it's super simple on this one. Super simple. And then the hourly trend up. So the 21 must be above the 55, and then the BBWP must be above 50 while having a positive slope. That defines an entry. So as you can see right here, 0 in this one, or obviously the moving averages are in that posturing. We see the yellow 21 above the green 55 starting here. Okay, so that condition is now valid. After that, we just wait for the next condition to be valid, because they will be simultaneously valid, which happens exactly right here on the closing basis. You see a closure above 50 percentile for the BBWP. Thus, we have an entry. There is no question about uncertainty with this. You just fucking enter there. You just do it. You just do it. And then when do we take profit? We take profit when BBWP goes below 50 percentile. And you can see that happens right here. And this, as simple of a strategy it is, it works. It works. Now, there are some other considerations on top of it as well that you could certainly optimize this with 100%. But in its base format, very simple. And then, of course, for our risk management, you know, we want to see a closure below that prior range low. So that would be the blue line right here. So does Bitcoin close below this line before the profit taking metric is hit? No. So we don't have to worry about that. So again, that having a strategy laid out in advance answers all these questions. That is the purpose of having a strategy, so that we do not have to make the decisions in the moment. We make them well beforehand. That is when you're not going to really feel uncertain when you backtest things. I mean, you might feel uncertain about what's going to be a working strategy, but that's fine. I mean, that we should be uncertain about that, because we won't know until we test, obviously. But after that, as far as execution goes, it's just up to your ability to quite literally follow these directions. That's it. That's all that it is. Now, that brings up the other thing, like, can you follow directions? Which hopefully, I mean, I don't think that it can get any more simple than this, to be honest with you. I think if you are dealing with other distractions and whatnot, then obviously you want to limit that. Now, for myself, I have this automation service, essentially trade for me. It's the Crown Quant automation, which actually we do have a link to over here as well. And it obviously does solve these issues. This one right here, where basically you can set up this sort of back testing stuff, to be done automated, and then you can literally have it execute on your behalf as well, if you so desire. So that obviously takes care of that issue. But if you are having other issues with, I suppose, maintaining discipline, discipline is a thing that you cultivate. It's similar to like going to the gym is the analogy that I like to use, because we all have that. We all know that we're supposed to go to the gym, and we all have had an experience at least once where it was difficult, where we knew that we were supposed to go to the gym because that was a part of our current, plan, our workout plan, but we didn't actually want to go. We felt tired that day. We were out the last night, or we ate like shit, and we just don't feel like we want to go. But of course, discipline is where that starts to kick in, and you say, hey, I can feel one way, but still do something else. You can feel one way and do something else. And maybe it might not be the gym, maybe it might be something else for you, but you've certainly felt that at some point in your life where you felt one way, but you did another thing. Maybe it was like going to school. I don't want to go to school today. I fucking hate school. But that you're supposed to go, so you go anyways. Because you fear the consequence of not going. Just like the gym, you fear the consequence. Like I want like a shape of my body, and if I don't do these actions in the gym, aka play out my strategy, then I cannot expect those results. It's the same thing. So that is that is actually probably the real psychological issue, if there is going to be one that people will face. But of course, we all have instances, examples of working through that. You can feel one way, but still do something else. You can feel bad, but still go to the gym. You can feel good and you can still go to the gym. You can feel like all sorts of things and still do the right action. It's all about the action. That is what it is at the end of the day. And that is why execution is king, and why we focus on that in this particular video with strategy creation and execution, because at the end of the day, it is your ability to just execute what you've already pre-planned out. And if you are uncertain with that whole process, again, the answer there is actually progressive desensitization, which is just taking those actions on a smaller level. So, in the gym analogy, it's like, hey, I don't want to go to the gym today because, you don't want to expend energy. But if I just literally go to the gym and not do anything, that'll be good enough. You got to start somewhere at least. So with trading, it might be, I'll start doing a paper trade account. I'll do pen and paper. And I'll take these trades on paper because I'm comfortable with that. I don't have to deal with anything else on top of that. And that's fine. Okay, if that's where you have to start, that's where you have to fucking start. That's completely fine, completely valid. From there, maybe you entertain a demo account on an exchange. Now you're on the line, so it feels a little bit more real. And once you get bored of doing that, or you feel pretty comfortable doing that, then you graduate to doing a very small dollar value account. And until you get bored of that, like $1, you're trading one fucking dollar. And then from there, you start to build up again, and maybe you now do $2 or $5 or $10 or $100, $1,000, 10,000, whatever, just whatever allows you to kind of ease yourself into that. And then you just trust your emotions will follow over time. Different scientists say different shit on this. Some people say, 2 weeks, some people say 3 months, probably somewhere in between there. The more often that you do it, I imagine, the faster that process will be. And yeah, that is probably where I will be leaving off on this video. A longer one, but it is a slow Sunday after all. And yeah, great place to end. Let me know your thoughts in the comment section below, because I'm actually curious, do you like these kind of videos, these more sort of deep dive videos? And is there any points that you'd agree with, disagree with, things that you would offer another, view on? That's all good as well. And perhaps I make a series out of this. So yeah, that'll do it for today. As always, I want to wish you the best. Take care, much love, and see you hopefully Monday.